Hey, gang. Today we've got a special guest for you. Raoul joins us to talk macro, crypto, and the future of everything. All right, it's a Money Talk special edition. So let's not waste any time. Let's do this. All right, let's do this. So joining us today on Money Talks, it's been a long time coming. We've got Raoul. Raoul, welcome to Money Talks. It's great to see you, my friend.
Great to see you as always, Bill.
Yeah. So look, let's get right into this. I'm going to give you a softball first. Are we in a recession?
Yeah, probably. I know everyone on Twitter's flinging poo at each other, whether it's a recession or not, and the government stepping in. But basically, 2 quarters of negative GDP, not good. Usually that's given a 100% chance of a recession. We haven't had confirmation yet from things like the ISM survey, the Institute of Supply Managers survey. That usually drops to about 47. I'm expecting that in the next month or two. And then we'll be definitely there. So we're there or thereabouts. It feels that way. The markets have traded that way. We're seeing job cuts coming. We're seeing a lot of evidence, and even the bond market's starting to tell us that. So it feels that the recession is here.
Yeah. So in very general terms, recession or not, what are the 2 or 3 indicators that you think that just a layman who's not a macro expert like you can look at regularly to get a reasonable understanding of the macro situation?
Okay. Firstly, the thing that gives you the best guide is something called the ISM survey. And you can Google it, you can find it, it's publicly available. And that basically, anything above 50, the economy's expanding. Anything below 50, it's kind of stalling. And anything below 47 is a recession. And that's been going since about 1947. It's an incredibly good indicator and really useful. So think of it as a kind of weekly version of GDP. So that gives you a very quick ballpark. And what's really interesting that no economists figure out, and I don't understand this, is it goes up and down. It's cyclical, right? Economists have linear projections. It's like, really? You can show a small child a chart of GDP and they go, well, it goes up and down. So what it does, if you see it going down and crossing 50, we're likely to be headed into a weak patch or a recession. If it's coming up from the lows, we can start looking forwards. So that's a really simple guide. The other way is the bond market's usually very good at this. So once yields start falling, bond markets are generally derive their price action from 2 things: GDP growth and future inflation. So if bond yields are rallying, it's saying that GDP is probably slowing down, i.e. there's a chance of stimulus to come and bonds look a safe haven. And secondly, that inflation is likely to come down in the future. So those 2 things alone give you pretty much all you ever need to know. Now, what's really interesting, the second degree of all of that is there's a bit of magic. So you look at this ISM survey, you go, well, how does it help me with my equity allocation or my allocation? All you do is just turn it into a year-on-year chart. And all of the year-on-year charts of every asset, from oil to bonds to commodities, to copper, to equities, to emerging markets, to credit spreads, are all the same chart. They're driven by the business cycle. And some things are pricing in more right now and others are pricing in less. So the bond market's pricing in less, as is the oil market. But things like tech stocks are pricing in an ISM of 35, which is a deep recession. So then it gives you kind of a relative understanding of, okay, where should I be looking at allocating my money? So there's some relatively simple tools.
So now I listened to you and I saw your really interesting conversation. I think you pronounced his name, Urian from Fidelity. And you all have a phenomenally compact, elegant way of explaining this. And so, but with so many people now starting to understand this, is this a self-fulfilling prophecy? Meaning what comes first here, right? When I see that the NASDAQ price in your chart is saying, the ISM is going to fall to match that because it has for the last 50 years. Is that now a self-fulfilling prophecy, or do the markets not think that way? Meaning, what comes first here, right? Is it a chicken and egg thing? And does that change over time if everybody understands the same thing?
Yeah, I mean, does technical analysis lead to price action or does it not? All I know is if you listen to Stan Druckenmiller over the last 20 years, every time he gives an interview, he says, you know where the economy is by looking at the internals of the stock market. What does he mean? It means things like consumer discretionary stocks versus utilities. If the economy's slowing, then discretionary stocks, i.e. the discretionary spending, tends to fall. Utilities are the things we have to have, so they tend to do well. They're all correlated with the business cycle. The business cycle, I mean, I've got business cycle indicators going back to 1870. They still work. So even though more people might look at them over time, I still don't think it's necessarily the driver of price action. If not, you would have seen more assets price in the same move, but we haven't, right? We've got bonds up here, haven't priced in much of a weakening ISM. And then we've got tech stocks, which are at the bottom, which are priced in a massive amount of weakening. So it's clearly not efficient yet.
Yeah. And we still see contrarians, right? So it seems to me that there's a lack of consensus on, is the Fed really going to have to pivot versus is that kind of long-term trend line downward on interest rates no longer, a viable predictor of where this is going. And so, what should be, over decades, kind of a reasonable road to consensus actually doesn't really feel that way, the way one might expect. Is that true? Or
so always at turning points, there is no consensus because there's a group that extrapolates the recent trend and says that's going to continue. And there's a group that extrapolates a mean reversion. Now, the question is here is more complicated because we've got these supply issues. We've got, onshoring. We've got other things that are muddying the equation. And what we've got is this big debate. So myself, David Rosenberg, and maybe Urian and a few others kind of think we probably mean revert because of debt, demographics, technology, that inflation's not a long-term issue. But there's a whole other group who I really respect who are saying, no, you're dead wrong. Inflation's sticky, it's here to stay, and it's a big problem. And we won't know. And this is the beauty of financial markets, right? It's game on now. We've got the game. We place our bets and we'll find out who's right and who's wrong.
Sure. But it does feel like in some ways, I realize that the talking heads are always going to be many of them are going to be a trailing indicator, but it does feel like many prices have either peaked or are starting to come down. And that's really what matters here more than the actual inflation level itself in terms of, we're going to get into crypto and equities and whatnot, but isn't that a more important perspective?
Yeah. All prices are set at the margin. And marginally, all prices are falling, except, even oil's fallen, but not as much as others. But stuff like copper that's very economically sensitive, been decimated. And we've seen that in agricultural commodities. We've seen it in all commodities. Now, Elon Musk tweeted out yesterday, somebody who'd been talking about the inflation in his supply chains, said, we're seeing prices peak.
Yeah.
Okay. Yeah. He is a consumer of a lot of different raw materials.
That's right.
And he's telling us this. And we're seeing that all over the place. So, okay, so why is it at 9% now? Well, inflation is a lagging indicator. It looks back over prices. So still we're seeing some companies pushing through price increases of commodities that they bought 6 months ago that they've turned into cereal boxes that they've now put on the shelves, right? So it's a delayed process. And eventually the delay comes the other way. The other big delay is rents. Because the housing market is slow to move. It's not like equity markets that can, move very quickly. So as the housing market comes down and mortgage rates come down, rents will slowly come down. But that can take a while. And it's the same with wages. So we're now just starting to see all the tech companies laying off people, all the crypto companies laying off people. So that's going to be pretty broad-based and pervasive. It's not gigantic because oil companies are doing well and other people are doing well. But that process then feeds through. So usually what happens is 18 months later, 12 to 18 months later, you get the reverse. And I actually think we go to negative inflation, which is not what anybody else thinks.
Right. I was going to ask you about that. I mean, I've been listening to Kathy Woods and I'm a huge fan of hers. And I think it's really interesting to see your intersection of macro, and you talk about exponential. And I'm a technologist at heart. I'm a closet guy who's worked in fixed income, but I don't have your depth of understanding. But the three of us have kind of converged from very different perspectives. I'm a pure techie who's made his career in working in exponential tech, and you come at it from macro, and she just runs funds that only focus on it. And that prevailing wisdom says, well, wait a minute, even with the money printing, it looks like there's a really good chance that we're going to end up in a deflationary environment at some point in the next 24 months that no one is talking about. And
I think that's right. So, one of the things people talk about agriculture right now. We're going to have this food crisis. Step back and look at the inflation-adjusted prices of agriculture for the last 50 years. It's gone down.
Yep.
Why? It's gone down, even though the population of the world has doubled. It's gone down because of technology.
Technology, absolutely.
Look at what happened with the shale revolution. Why did oil fall so fast in kind of the 2016, 18? It's because shale was a new technology. So what people are saying right now is none of the supply issues can be solved by technology. But because you're closer to it and where you're based, is that everybody's trying to solve it. So everybody's trying to solve, because there's supernormal profits in solving supply issues. So you focus your attention and your capital on solving it, and you'll make money.
Yep. Do you think that? Well, actually, I want to ask you something first. Have you talk about the dollar for a second? Have you been reading Arthur Hayes's blogs where he's been talking about? Yeah, absolutely brilliant. I don't know how this happened, or maybe he's had more free time the last few months, but all of a sudden he's evolved into this kind of no longer in the closet economist. And he's been writing lately about yield curve control to basically stave off a calamity, right? That's brewing in Europe and Japan. What's your perspective on, is the U.S. really in a position to step in and do the kind of yield curve control necessary to potentially save the yen and the euro?
So yield curve control is only applicable when yields are rising. Right, but we're both talking about a recession where yields are falling. This is why dollar yen is now going down, i.e. the yen's going up. Why? Because the Japanese, the yields are just starting to ease off, so they need to buy less bonds, i.e. sell less, create less yen. So it only works in that point. So when we go back in time, I find the best example of this is, it's actually the most similar time to now, which was 1947 to 1955. So 1947, why am I talking about such a long historic period that nobody knows anything about? It's because we came out of World War II with massive supply issues. So we had the same supply problem, and then we had everybody coming out of the military into the labor force. So that's the same as the pandemic. And what happened? Prices went up 20%. They then were negative 4%. And then they were sort of around the 3% mark for a period of time. And what the central bank did was, what the government did is fiscal stimulus. They knew the economy needed fiscal stimulus, which I think the US and all the economies do. We need to build the green infrastructure, the technology infrastructure, all of these things that have been abandoned for so long. Now, in a boom time, when the economy recovers again after this, you might want to cap yields and say, we don't want this business cycle that we've just had, where we have a boom bust again. So in which case, maybe they cap them at 3% or 2.5%. And what you're trying to do is have inflation running slightly hotter, but not much, than your yields. Those negative real rates mean you should get productive return on assets if you do it properly. So I think it's coming. Europe is basically there now. Japan's been doing it for a period of time. And it's also been a function of demographics. They can't allow debts to rise because you blow up the whole system. And the European banking system's a mess as well. The US banking system's better.
Yeah, well, which is, I'm not even going to respond to that. You're right, but I guess everything is relative.
Exactly.
So in my mind, clearly, well, not clearly, but as we've discussed, in my mind, we're either in a recession or moving into one. But the equity markets may have already priced that in. Excuse me. And a lot of my friends, including a lot of our clients who are watching this, say, well, clearly we've got more pain in store from equities, but in prior recessions or moving into the prior recessions, right, the bottom was already in. And so
this is another big debate going on, right? I interviewed David Rosenberg yesterday, and he's like, no, the markets take a year before, they bottom only like a quarter before the end of a recession. I'm like, we don't know how fast this is going to be. I think it's faster. And I think the bottom from my forward-looking indicators I've been putting on Twitter and stuff suggests kind of February, March for a low, but it's a sharp low. So we have a big cliff drop. And then as bond yields fall, commodity prices come off, etc., monetary conditions loosen. So if we go back to 2018, when the Fed pivoted, the market had started going up already. And we had an inverted yield curve. We had growth, we had the ISM going below 50. We had all of the elements of recession, but the market started looking forward to the stimulus because we know in the past, in 2000 and 2008, we had something called interest rates, which people might not remember, but we had interest rates which we could cut.
Right.
And that was a slow process that worked its way through the economy. But now we don't really have interest rates. So whatever they are, 2 and a bit, right? You basically lose all of that in 2 cuts. So what happens is normally in a recession, to get through a recession, it's normally 500 basis points over time. So the extra part is quantitative easing.
Right.
The market knows this. Quantitative easing is debasement of currency, asset prices go up. So I think we've changed the dynamic. I think the market's forward looking. Now, do we go lower if I'm right about the next recession? Possibly. But I think it's very 50-50 because I hear everybody saying it must go lower. That tells me everybody's underweight and the pain is if it goes higher.
So if you didn't hear everybody else saying 50-50 and you stuck with what you know, would you really be saying 50-50? Or are you factoring in all these little, devils standing on your shoulder, whispering in your ear, you're nuts?
Yes. So I don't know if equities have bottomed. My work suggests they should come a bit lower. But everybody else is starting to move towards we've got inflation, the Fed are going to go further, and therefore the equity market should fall 50% like it did in 2008 and 2001.
Yep.
And I'm just thinking, well, there wasn't quantitative easing yet. And their argument would be, well, how can they ease with inflation so high? I go back in history, they've always eased with inflation this high. Back in the 1940s, 50s, 60s, 70s, 80s, 90s, 2000s, they ease when inflation's at its peak. So I just don't buy that argument, but I could be wrong. But yes, when I start to hear the vociferousness of the voices saying they're definitely going lower, this is a sucker's rally, I start thinking, the path of pain is to go up and discount this in advance.
Right.
Because markets pretty much record underweight equities.
Yeah. Okay. So the path of pain is to go up. That makes perfect sense. Now let's relate that to crypto. How do you value crypto? Is it the same? Meaning, is your mental model 100% correlation, or is there a mental model where they diverge, or you don't even think about it that way? It's just the network effects.
There is passing correlation because liquidity. So if we think what causes the correlation that we see right now, well, it's actually stopped, but the NASDAQ and the S&P, right? Liquidity and inflation, 2 big macro factors. So the liquidity cycle, call it global M2 year on year, drives the crypto cycle.
Yeah.
Because it's liquidity, right? There's how much money's in the system. Can I buy more of that stuff or less of that stuff? Fine.
Right. So when you say liquidity in the system, I for our simpletons, I think of it as manna from heaven, right? So heaven is the Fed, and the manna is the cash that they're going to sprinkle on us like pixie dust that allows us to buy more of these risk-on assets or assets that we're not currently buying, which I think is that more or less the right way to look at it?
Exactly. So M2 is money supply. How much money's in the system? Therefore, it's easier for you and me to have money, easiest to put it in the market, right? Boom times, there tends to be more of this stuff, but they tend to really ramp it up during a recession because they're trying to get the economy, give it more money.
Okay. Yep.
So, that's the driver in the macro sense. But when you zoom out, there's no bloody correlation.
Yeah.
Why? Because these are network adoption models. So they go up and to the right in a logarithmic channel over time.
Yep.
So the long term is a secular trend, which we don't see stopping. We don't see even the number of active addresses and all of those kind of measures of the network are much better than they were in 2018. Even the percentage declines. So we're seeing the network adoption, which is why every time we have the big sell-offs based on this liquidity, they're at higher prices every time. That doesn't happen to most other markets necessarily.
Yep.
So we've got this network adoption model, but then in it, we've got the cycles that are driven by the macro. That's a great understanding we've now got. So where are we today? Fascinating. So we're right at the bottom of the liquidity cycle. So this is where, when M2 growth is negative, i.e. liquidity is coming out, assets should have sold off their most. So the next phase is the same as the bond yields falling, is we need more liquidity soon because we've got a recession coming. Right. So the crypto markets sniffed this out 2 months ago and went, we know where this goes, because crypto is a very forward-looking asset. So the crypto market based, and that basing was exactly on the regression channel. It was exactly within, all of these parameters, stuff like the 60-month exponential moving average, the 5-year moving average, exponential moving average, all of these measures, the most oversold RSIs in history, everything all happened at the same time at the bottom of the liquidity cycle. It's like, okay, this is going to give you a very high probability, no certainties, that this is a low. So the liquidity cycle is going to change. So that's the macro forward looking. In 18 months' time, are we going to have less money in the system or more money? The answer is 100% chance of more money. Because if not, we've blown up the entire world's economy.
So those of us who've been through the crypto cycles 4 times, right? It always feels to somebody who may have just gotten in like, oh, crypto is done. I've got in at absolutely the worst time. But the reality is none of that matters, except for the fact that we've achieved maximum pain because we have the lowest level of liquidity we're going to have in this cycle. But you need to kind of, when they say you need to be in it to win it, the further in it you are in terms of being able to appreciate this, the more you understand that historically, your chance of making a profit if you buy right now is unbelievably high.
So right? I think this in risk reward. So let's say I'm wrong and there's more pain to come, which a lot of the crypto markets think. So let's say the downside is 40% from here. Okay, that's a decent sell-off from here. What is the upside? Well, every time you've gotten to the bottom, it's around 10x, maybe more. Right. And depending which token you choose and how well you allocate your capital. So 40% downside, 10x upside, that risk reward is enormous.
It's actually more than 10x, but yeah, I mean, it's only happened a couple of times where it's really a true bottom of the 2 standard deviations below, right? But that's 40x, a little bit above.
But even if it's 10x, 20x, right? The number is, it's huge, right? So that's one of the best risk rewards you'll ever be given in your career. What's amazing about crypto, why it generates so much wealth, is because you get repeatedly given these.
Yeah,
and that's why technology is done amazingly for people as well. Technology investing.
That's right.
Because people have this mean reversion mind frame and they think it's all over. The reality is it's always going up to the right, just within these volatile bands. And the other thing we talked about talked about people being underweight in equities.
Yeah.
So I also run a asset management firm called Exponential Asset Management, and we allocate to hedge funds in the crypto space. There are many hedge funds sitting on 70% cash, as there are people like Kotu in the technology investing world, 70% cash. Where is the path of pain, down or up? Because they've got a big problem to their investors if ETH keeps rallying. They've got a huge problem. Now, part of me thinks, well, does ETH just stop at this kind of 1,800, 2,000 level where there's all that resistance? But that's kind of would let these guys in. And the market doesn't do that until they're in, and then it corrects sharply. So I'm just not sure, but it feels like the path of pain is higher.
So that's actually what I wanted to talk about next, Ethereum. So let's break this down, right? Because it's unbelievable what's happening with Ethereum all at the same time, right? So on the one hand, Ethereum has tremendous cash flows, like over $1 billion a month in cash flow in crypto terms, right? On the other hand, it's actually migrating away from the model that generates those cash flows. In other words, it's moving away from proof of work to proof of stake. And then there's a third variable that's creating deflationary pressures on the asset, where effectively the new models are burning Ethereum every transaction cycle effectively. So Ethereum and ETH is basically becoming an incredibly complex economy in and of itself. How does all of that factor into your mental and physical models for all of this?
So I'm going to make it easy for people. Everything is about supply and demand, right? The more supply there is, the cheaper it is. The more demand there is, if supply is stable, the more expensive it gets, which is why we've had the problem with prices, because there wasn't supply of oil, but there was demand as everybody came out of pandemic. So what have we got going on in ETH? We've got a gigantic supply shock. So what is the supply shock? The small supply shock is right now, every day, miners are selling ETH. They probably sell 80% of everything they receive because they need to pay for their cash flows and their electricity and all of this stuff. So they stop. That's about 1 or 2 billion a month. Okay, that's nice. But then after that, we've also got the fact that staking is coming.
Mm-hmm.
Currently, there's about 9% of all ETH staked. Now, estimates are it should go up to around 30%. What does that mean? It means 30% of the ETH comes off exchanges, comes out of DeFi, comes out of CeFi, and is untouchable.
Yep.
Right? You're removing a gigantic amount of supply from the market, and it's locked for a year. So you can't do anything about it. Yes, you can trade using wrapped, staked ETH and stuff like that, but it's not the same thing. So you've got this. So you're taking that out of the market. So you've got a huge supply shock. On the other side, you've got a massive demand shock, which is firstly, a lot of institutions wrongly didn't like Bitcoin because of ESG concerns. Proof of stake gets rid of that. Additionally, it now has a yield. So that's something that institutions love, is a yield. So now you need to make one asset allocation decision, which is, I believe in this Web3 technology world. So where do you allocate? Bitcoin or ETH? It's going to be ETH. Why? Because you're going to get something between a 6 and a 10% yield.
That's right.
So that's extraordinary. And you've got this deflationary issue of burning the tokens based on network activity. So that's another massive supply shock. So there's less ETH around every year. It's getting locked up. And you've got no miners. Put against this massive demand shock, and we've got the macro cycle turning. I look at this and think, holy shit, this is a massively imbalanced supply and demand situation.
Yeah. I mean, we shouldn't underestimate the complexity of what's happening right now. I mean, it's like, as a techie, I can tell you, it's like the best example I could give you would be like changing the engines for an airplane mid-flight without landing. And
with a new technology. With a new technology.
Right. With a new, relatively unproven technology underpinning the engines that you're replacing the old engines with. And so it's pretty clear to say that, well, they've admitted it 100 times now, that they've all underestimated, the entire developer community underestimated the complexity of this. And this is just one upgrade of a few to come, because we haven't gotten into sharding and other things that actually provide massive scalability to the network. But it appears to be working, and they've done it right, which is part of why I'm so incredibly bullish on Ethereum right now. And this is something that we've talked about here on Money Talks many times. Do you view, well, it sounds like you view Bitcoin very differently, and you've alluded to why. Do you hold Bitcoin still?
Barely, which I know everybody hates, right? Barely. Not because I don't like Bitcoin or don't think it goes up. I just think it goes up less.
Yeah.
You know, we're looking at this as a technology and a network adoption model. So you want to back the network that's growing the fastest and has the most number of applications. That's the safest, easiest allocation. That happens to be ETH. Now, other earlier stage tokens, whether it's Solana or AVAX or whatever, are getting earlier on the adoption curve. So you get that accelerated phase. So they'll probably outperform. But if you're just thinking the safe, easy bet, we're now looking at the internet. The money of the internet is ETH currently. Nothing is exchanged in Bitcoin. Right. I mean, literally nothing. So the money of the internet is ETH. DeFi is built on ETH. NFTs are built on ETH. All of this is being built on ETH. ETH now has a yield. Stable coins are on ETH. And ETH has a yield. Okay. what's left? Yes, it's not fast enough, so people go to other chains for that. It's a bit more expensive. People go to other chains, but the broad encompassing of the space, this is the simple, easiest bet to take.
Yeah. Will you do other crypto allocations to the Solanas in smaller amounts to, potentially look at that 100x upside given where they are in the adoption curve, or is there no point given the numbers we're talking about?
I just don't think I'm good enough, and I don't have the ability to spend all the time in the space. So that's one of the reasons I started the asset management firm, so I can allocate it to hedge funds whose job is that.
That's what we do.
So I do that.
Yeah.
But I do have a few bets. So I have a small basket of like DeFi, Uniswap and stuff like that, Aave, whatever. But I also have the only other bet I'm taking really is Solana. So I've started to build a reasonable position in Solana because it has the next most number of developers, the network activity, and it's clear that their mission seems to be to use it as a blockchain for the masses. So, music, gaming, all of that kind of stuff. And I think the next phase is that. The next 200, 300 million people are going to come out of mass adoption and not from crypto heads like you and I who've been around for a while. And so I think Solana's a reasonable bet. Now, the chain breaks, it's not perfect, all of this stuff. Nothing's perfect, and that should be in the price. We all understand that.
Right. So actually, speaking of which, I'm actually visiting family in New York, so I'm going to go visit this new Solana store in a couple hours when we're done, and I want to segue this into a last discussion, kind of memes and the NFTization of everything. But before we do that, like, what brings all of this wondrous discussion on how we're all going to make money on this next cycle come crashing down and go horribly wrong? Do you think about like what that scenario might be that has a non-zero chance of happening?
Clearly, if inflation stays higher for longer and rates stay higher for longer, crypto won't recover. Does it go further and lower? Possibly, because we haven't tested it in that environment. So the macro is one. Obviously, there's always the threat of regulation, but they tend to be temporary in nature. We've seen China, we've seen India, we've seen everybody kind of toy around with different regulations. It moves the markets for short periods of time, and then money gets reallocated through the system. So I think the macro is probably the biggest risk. And because I don't see how the network by technologists is not adopted. The technology genie is out of the bottle, and that's not going away. So every time you trade below trend for an extended period of time, you're getting cheaper and cheaper and cheaper versus the log trend of adoption. So Metcalfe's law makes it very difficult for assets to stay down for a long time, which is why everyone gets frustrated with technology stocks, because they're not cyclical, because they're driven by the same factors.
My theory is that Bitcoin might have peaked at 80 to 100K if the China mining ban hadn't interrupted the network effects that were happening obviously we'll never know, but it seems logical that we kind of crashed into a wall on those network effects, had to drive the big car around the wall by moving a whole bunch of stuff to the west. And that's all behind us now. At the same time, right, that the liquidity has troughed potentially, which could, again, it's just more potential fuel, all kind of coming together at the same time.
We had that double Wile E. Coyote moment at the top, and I didn't see it happening. One was the China ban, which I knew we could discount. The market fell and then rallied back up again, right? Because it moved the hash power elsewhere, blah, 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 it sorts itself out. But when we got back to the top, what we didn't realize is that discretionary spending had collapsed.
Right.
Because of inflation. So everybody had something negative real wages. So they didn't have the $100 a month to put into Bitcoin because they had to pay their electricity bill.
I missed that 100%. 100% missed it. I mean, obviously it's always easy in hindsight, and it was kind of obvious in hindsight, but it'll be interesting thinking for myself about how I view that the next time it feels like they're going to have no choice but to put the brakes on quantitative easing. And are we going to accept the fact that liquidity is going to dry up again, or are we all going to be driving the rocket towards the cliff, assuming the rocket's going to keep,
Well, markets always do that. My guess is that volatility comes down as more people join the network. So
Sure.
Therefore, each drawdown, as we're seeing, is less than the previous one.
Yeah.
So if it's like
well,
60% this time, what's it next time? 40%, let's say. So
that's why Apple talks about services in their earnings calls, because everybody has a smartphone now. So you have to move on at some point to the next thing,
Yeah.
All right. So I want to talk about NFTs, and I want to talk about memes, and I want to talk about all this craziness that I see every day on crypto Twitter. So I've seen several interviews on your Real Vision, and I've seen you talking, tweeting. Why are NFTs so important to you?
People don't yet realize what NFTs are. Everything we do in life, including me coming on this podcast today, is a contract. An NFT is a unique contract. Forget everything about what it's being used for currently. Almost everything we do, from derivatives in financial markets, through to insurance, through to attending a concert, through to education and getting a certificate or anything, they're all contracts. The technology now allows these contracts to be verified and all the stuff that we know with blockchain, right? So you've now created a global marketplace for contracts. But the first thing that came out of it was art, bizarrely enough.
Yep.
Because this technology allows to solve a number of issues about who gets paid for what, right? A contract for a piece of art, I buy the piece of art from Damien Hirst directly, he gets paid once. Then after that, he never gets paid again because it's not linked to anybody. But the smart contract changes the entire equation, so he can participate in his own network, which he couldn't do before.
Yeah.
So NFTs are that. NFTs are another thing. It is the proof case of community and what it means to coalesce groups of like-minded people around single ideas. Whether that's the DAO structure of the Constitution DAO, which didn't actually achieve its purpose, but it was an incredible getting together of capital, $46 million in like 3 days around one idea, or whether it's a shared idea in the IP, which is, let's say, Yuga Labs, Bored Ape Yacht Club ecosystem, which is where we're building a media company from scratch based around community from the ground up.
Yeah.
So communities can get together and authenticate each other. So it's club membership, it's collectibles, it's shared purpose, all of these things together.
And
it's also digital identity. It's also digital identity, which is another big thing.
It's part of the same thing, right? So why is membership, when you really peel away what's happening, it seems that membership-based models, whether it's Moonbirds or Bored Ape, being a member of the yacht club, and last night, I don't know, I was listening in on the spaces while I was working with I hate to say it, the crypto dick butt community, which I find absolutely hilarious. But it's all membership, and you feel like you're part of some internet protocol based club. Have you thought about this?
Yeah. So you and I have a shared common interest that was one of the first things we discussed that authenticated both of us, is we both work for Goldman Sachs. Right? That is a club that we're members of. It's a very exclusive club because you cannot join it unless you've actually been part of it. Right? And that's a networking opportunity.
Yep.
Humans do this everywhere, whether it's golf clubs, restricted access, whether it's a live event where you go and see your favorite artist. There's 10,000 people, there's the only tickets to be sold, and you're part of that. It's the human experience in digital form that we would have done otherwise. Like, I'm here in my house in Little Cayman today. There's 140 people here. It's a very exclusive little club. It's not because it's a very exclusive island. I mean, there's some fancy houses and some very, very ordinary ones, but it's because it's an exclusive place and I have a community. But we now live most of our life online. So online, we want to create the same societal structures that we have in our physical world.
Mm-hmm.
And that's what NFTs are enabling, because it's a very human trait.
Why do we need the NFT to make us feel like we're a member? I mean, what changes in being like, I could send an email out to a news group and I can say, if you're interested in joining, my club, I'm going to commission an artist to send you a bunch of 8 pictures and you can all join, and that's it. And if you want to join, click on this link at a certain time and I'll set up a Google Meet or whatever, and we'll just talk, and we'll basically have our club.
So firstly, it's authenticated that you're part of that club.
Right.
So golf clubs have had this for years with debentures. Right. Debentures actually a lot like an NFT. So you want to join some fancy golf club, which I don't, but let's assume I did. A fancy golf club, you buy the debenture, it costs you 200 grand. Okay, but it's actually not a cost of 200 grand. Yes, you'll pay club fees each year, but that 200 grand gives you the right to even go to the club. But when you want to leave the club, you sell your debenture. And NFT is the same thing. So it authenticates you as a member. You can prove it to anybody, which you can't do with the debenture very easily without going around with a contract signed and notarized. So you can kind of prove it everywhere. You can use it for other authentications by joining other communities because you're part of that community. And if you want to leave the community, you can sell it. So you're basically staking money to be part of a community, to say, I value this community enough that I want to tart some of my capital just to be a member without paying membership fees. It's kind of interesting.
So I spent a lot of time, obviously, live in California. So I spent a lot of time in LA, and obviously in LA, it's very media centric, and invariably you go out and everybody's name dropping. I work with this artist and this artist and this artist. And when they find out, oh, Abra, and I'm working now with NFTs, and, and everybody starts name dropping about what all these artists want or are trying to do in the NFT space. And every project that I've seen so far that has been brand centric, artist, existing media artist, music, whatever, artist centric in that media world, in the NFT space so far has either failed, hasn't gotten any mind share or traction or anything of value yet. It's all been these membership models that to some degree purport to move the Ethereum in kind of a circle among people that were already in the crypto club.
You've answered your own question.
Yeah.
So if I go outside, if I go down to the village and say, hey, listen, have you got the latest, XYZ pop stars NFT? They're like, what the fuck are you talking about?
Right.
But if I go to you, you might say, yeah, I looked at it, I didn't like it, because you're in that economy, which is the economy of ETH and Solana and Tezos, right? But these other people aren't. So the artists have struggled to get network effects yet.
Yeah.
But most of them are doing it at small scale to test it.
Right.
The reality is, we all know that culture is the new asset class. We all know that tokenizing culture via NFTs and social tokens is probably one of the biggest unlock of business models ever. We move trillions of dollars of intangibles off balance sheets to tangibles because they get tokenized, culture, community. So it's a matter of time. And they are learning. We're seeing people like Timbaland is doing interesting stuff. We're seeing Snoop Dogg is making decent progress. People are making progress. But as yet, we've got the problem is nobody knows what a bloody wallet is. But don't forget, there's big things in the background that nobody thinks about. Is Meta, Instagram, which is the largest place of all people in the world to hang out and talk about cultural things, is going to allow authentication by NFTs. Now, how long before those NFTs can allow you to be part of a private group? I doubt very long. We're seeing, my guess is Spotify will move this way. My guess is all sorts of people will move this way, and wallets will become ubiquitous. How long before my iPhone has its own super secure wallet attached?
Right, like the Solana phone, right, which is a reference designed for doing just that. So we looked at this about 2.5 years ago, and we call it the Metamask madness problem inside of Abra, where something like certainly double-digit percentages of any assets instantiated inside of Metamask have been lost. And I'm not even talking about the money lost in DeFi, where pretty much everyone who's not a a bank loses money in DeFi. But if you put an asset in MetaMask, I don't mean to pick on them because it's incredible what they've achieved from a technology perspective. But this is not just about technology, right? Double-digit percentages of that stuff is just gone because people didn't realize that the key was actually, oh, that's on my laptop. I thought that it was, in some MetaMask bank somewhere. They're not a bank for my NFTs. So we took a totally opposite perspective and have created a product now that we're launching in a few weeks that actually treats Abra like a bank account, like it already is effectively, but now for that MetaMask-like key so that you don't actually see the key. And the challenge was it took 2 years to build because it's really easy when you put the key on a phone or a laptop because all the complexity is basically consumer facing. And so our take is, as we've analyzed this, is that we went from MP3s to music streaming, and my 15-year-old has no idea what an MP3 is. Think about that for a second. Never heard of an MP3. Okay, he knows what streaming is, of course. Now we're going to be in a world where 5-year-olds of today in 10 years have never heard of an NFT. They don't know what it is, but they're going to be using them via these bank-like accounts that I'm describing for everything. Everything. It's going to unlock your door. It's going to be the coupon at the store. It's going to be the membership, token that you present to get in the virtual club, et cetera, et cetera. And I feel like this is really important, what we're going through now, but the public hasn't, even those of us in the circle moving money around to buy crypto dick butts aren't really getting the implication of the tokenization of everything.
I mean, I've started another business outside of the asset management business. I've started a business co-founded called Science Magic Studios, and we've got some of the world's most kind of famous investors behind us. And what we're doing there is tokenizing the world's largest cultural communities. So we're going to help people in that journey, and it's a token studio, so we get paid in tokens for participating in the network, but by creating the network for the world's biggest pop stars, sports teams, movie, TV, book franchises, and fashion. Those are the big cultural relevant communities. And look, every brand is talking about this. It is all coming. Just because we haven't seen it today, people like the economists who look at the linear trend are assuming that everything today is what tomorrow will be. But you and I know that is not the case because the amount of smart people building stuff. So that, I think, is the next massive wave. So when you speak to me now about, well, this kind of music artists and some of the sports teams hasn't really got traction, that it's ... yet.
Yeah. So how do you think about the tokenization of everything in the macro view? How do they tie together for you?
Well, look, every single asset that is not on a blockchain generally has a friction in moving it, storing it, or owning it. And what you're doing is getting rid of a lot of friction. So let's go the conversation I had with Sam Bankman-Fried about the securities industry. There are trillions of dollars tied up in T+2, T+3 settlements, trillions of dollars in cross-margining for derivatives and all of this stuff. Right, putting these on the blockchain just frees up capital from the system. Okay, that's good for economic growth and allocation of capital purposes. But that happens kind of everywhere with all the middlemen taking stuff, with everybody. There's friction points all the way through. So what it should do is help increase velocity of money, which if you look at the chart of velocity of money over the last 30 years, it's actually linked to demographics, and it's been going down and down and down because we've got this aging population. But what it should do, I think, is over time should drive productivity and growth in this new digital economy above and beyond what people expect. So I think this is an unlock of new GDP that comes onto the world, things that didn't exist, like $60 trillion of intangibles become tangibles. What that means is you've now got money for it that did not exist before. That money can be spent, invested, rebuilt. It's like, I've talked about this before, it's like discovering the Americas. We didn't know that this massively fertile land and in the South with all of the gold existed. And it was very underpopulated. As soon as it did, global GDP went up.
So we did a partnership with a company called Proppy. I don't know if you've heard of them. Basically, they're trying to take the real estate company, and they've been out quietly buying title companies, which is, obviously the closest thing. And I actually worked on a system years ago before crypto called digital titles, where we were trying to do this in a centralized model, rights over IP. And they're physically doing it now with real estate, where they're trying to turn titles into NFTs to make them really easy to move around. And you think about the settlement of physical assets and all of the players that are in the middle of stock trading. Why did GameStop trading go down at Robinhood, right? It actually has to do with the settlement process involved in settling those trades, right? Because if it takes X days to settle, you're using ACH in the US. In the US, you have 60-day chargeback rights if you fund a transaction via bank ACH. And it takes a couple of days for that GameStop to settle. GameStop's going up and down 10% an hour during that craziness. And if you don't like the direction, you're just going to reverse the ACH transaction. So you've got all of this risk. And the SEC basically said, yeah, it actually makes sense. Now, the public doesn't understand all of this, but it probably makes sense for you under these conditions to stop trading in this thing, because you have now all of this risk that you're exposed to, your underwriters for those transactions. And it goes on and on and on. In real estate, 30 days. I worked on distressed debt desk, where we were selling, Russian debt or LBO debt from the 80s, 45 days to settle, distressed debt transactions. This should all basically be tokenized and settleable in one block cycle.
Think about other gigantic wastes of capital. You book a hotel room because you're going back to LA, and suddenly last minute you can't make it.
Yep. You
lose your money. There is no reason that ticket for the hotel room should not be tokenized.
It's yours. It's a concert ticket.
You've paid for it. Yeah. So therefore, think of all of that capital that gets freed up from the system. The hotel actually would rather somebody staying there, because you'll have room service and you'll buy a drink in the bar, and as opposed to having the empty hotel room. So it solves things for people, flights, all of these pain points all go. And there's tens of trillions of dollars of capital globally tied up in this kind of mess because it's inefficient method of settling and transfer.
Yep. Okay, so last question. What NFTs do you own? What is interesting to you? Now, I'm going to be disclosing I'm building an NFT collection, because we're going to have this gallery view in the Abra app, and I haven't disclosed it yet. So I'm going to build a web page and put it all out there. So I'm trying to figure it out. I'd actually need advice. So I've been talking to all my friends. My friend Sam's, at the Galaxy's a huge NFT collection. What do you think about this? And so, and by the way, I used to, as a kid, I was a programmer. So I used to generate Mandelbrot sets for friends, which would take 6 to 7 hours on an old Amiga computer to generate. I have no idea if you understand anything I just said, but basically Mandelbrot are these fractal images. You've probably seen them and didn't know what they were, where if you just keep zooming in, you basically see new things. And I would generate them for friends, because on my Amiga, I was the only one that had one, you could take the 6 or 7 hours to generate the pretty picture. Now you can basically pinch on an iPhone and you can zoom in and zoom in and zoom in. And so I'm looking for those, because I was basically it was basically generative art, where we call it now in the NFT world. So I'm trying to figure out what I should basically be investing in that's personally interesting to me.
It's really complicated, because what you're trying to guess is human taste in 10 years' time. Right. So what I've done is I've taken a macro model that I know works, which is network adoption. And I've said, okay, what is the most vibrant network in this entire space? It's Yuga. So I've basically bought a bunch of different projects around Yuga. So I've got my Bored Ape, I've got my other side, I've got Jenkins the Valet, and all of these projects that are going on around it, just to see how that evolves over time and what rights that ape has at the center of that ecosystem. The other side, I bought the Damien Hirst, the currency. So Damien Hirst, being a famous artist, one of the highest selling artists of all time, he did an experiment of 10,000 NFTs that you could burn and have the physical picture, or you destroyed the picture and kept the NFT. That happened yesterday. It's about 50-50. So there's 5,000 NFTs, 5,000 paintings.
Yeah.
And I'm really interested. Damien Hirst has got his own network effects anyway. So
where do you think people are going to go? What's your prediction?
Well, it went 50-50, which was which I didn't expect.
Okay, so it's already unknown. Yeah,
it happened yesterday. It happened yesterday. Damien has kept his 1,000 as NFTs, which was interesting.
Very interesting.
Yeah, I think this is the future. The other thing I own, like MFers, because it's CCO. I own Rec Guy because I just think it's perfect for the bear market.
Yeah.
And I've got a few other bits and pieces. I'm not a huge NFT collector because I just don't have an edge.
Yeah. Yeah. I'm just learning. I mean, look, I've been dealing with this idea of rights over IP. I can send you patents we worked on 15 years ago. And I worked on colored coins with some friends, and we were reminiscing about it a few days ago, which was this way of encapsulating rights over Bitcoin. Because Bitcoin doesn't have smart contracts. And so we figured out how to put the meta information in there. And but I'm not an artist. But by the way, why has nobody created a community of people who are fed up with crypto Twitter and the toxicity, like the the base agent to the acidic crypto Twitter community? I would think that there would be 5,000 people interested in that. So maybe that's something that
it is Discord, but it doesn't work in the same way. So we're struggling without a platform. That's right. The issue. We don't yet have a platform. I know they're coming. Everybody's working on them, but we need it, and we need to be authenticated, because it's enough of the anons trolling for engagement or because they're having a bad day. We just need, but that's what NFT communities do, right? They put like-minded people, you authenticate yourself, and now you kind of have to be nice to each other because you're living in the same village as them. Because if you're an arsehole in Little Cayman, people are going to call you up on it pretty soon, and you won't have any friends. So we've got to do that. Now, unfortunately, I've got a hot bill because I've got another.
But the degree to which somebody will call you an asshole is always proportional to the distance they are when they're talking to you at the time, right? So somebody who's 6 million miles away on Twitter is going to call you an asshole to you way faster than the guy 100 feet away.
Yeah, if they're having a glass of wine at my bar here, they're not.
Exactly. Yeah. So I wanted to let you do a shout out for your new educational stuff on Real Vision. I know you got to go. Super interesting. Why don't you give people the TLDR on that, and we'll let you go.
Listen, everybody's now learning that crypto is macro, macro is crypto. Suddenly people are realizing, oh shit, I don't even know how to think about this stuff. And also people are learning that they don't really understand risk management. They don't understand how to build portfolios. They don't understand a lot. And that's okay, because so many people have come into markets in the last 3 years. And what we wanted to do was give people the tools at Real Vision to get a world-class education, but not from just some random guy in a classroom, but from the world's best investors, and create this incredible immersive video style course and community around it at a price, normally a course of this kind of quality. And it's built by an ex-head of prop trading and equities at Goldman, who was with me at GLG, big hedge fund. So this is not a nobody who helped us build this. And then we built it out with the most famous people in the kind of financial markets. Normally that's $3,500 product. It's part of the Real Vision Plus membership now. So we're giving it free with this, with the Real Vision Plus membership. So there's a deal going right now. It's $399 for the first year. It's a no-brainer. If you can't invest that in yourself, I can't help you. And so go to realvision.com/academy. Have a look. It's really, truly groundbreaking.
Awesome. I will be. Hey, man, thank you so much. I know you have to jet. It's been a long time coming. I'm looking at the live stream. So many people expressing gratitude for your time on this. I think this is going to be a popular one, and I hope we can do it again real soon. Thanks for doing this for us.
Next time we need to book 2 hours. Because
let's do that. Seriously, we'll do that. Yeah. Absolutely. All right. Be well.
All right, my friend. Take care, everyone. Thank you for joining.
Right. Yep. Cheers. All right. Thank you, Raoul. And that's a wrap. I'm exhausted, mentally exhausted. We got through it all in an hour. I'm really excited to get everyone's feedback. If you have questions, follow-up questions, we'll do them in 2 weeks. So we are going to take off a couple of weeks, most likely. I may try to do one on the road. I'm gonna take a little bit of well-needed rest after all the nonsense going on in the crypto space for the last couple of weeks. So in the meantime, have a fantastic weekend. And thanks again, Raoul. And thank you, all of you, for all of your support and for joining us here on Money Talks. Take care.